Are you ready to unleash your financial superpowers? Welcome back to my investing series. In the last video, we covered the basics of understanding earning money and building wealth. Today, we're going to dive deeper and discuss more advanced concepts. If you missed the first one, you can find it in the description below. Have you ever wondered how a tiny piece of your favorite company could turn into a treasure chest? Well, today, we're diving deep into the world of stocks. At first, what is stock? Some of you know, but I'll tell you once again. A stock is a piece of ownership in a company. When you buy a stock, you're buying a share of that company. So if the company does well, the value of your stock will go up. And if the company does poorly, the value of your stock may go down. Stocks can be a great way to grow your wealth over time. Now let's talk about way to make money from stock. The primary ways to make money from stocks include capital appreciation and dividends. Capital appreciation happens when the stock's value increases over time, allowing you to sell it for a profit. Dividends, on the other hand, are periodic payouts from a company to its shareholders. Diversification is key. Invest in a mix of stocks from different sectors to spread risk. Consider long-term strategies, such as buy and hold. Now, how stock works? Well, buying stocks is like having a say in the companies you love. But how does it work exactly? Stocks represent ownership in a company. When you buy a stock, you become a shareholder, entitled to a portion of the company's assets and earnings. The stock market is like a giant auction, where buyers and sellers determine the stock's price. Supply and demand dynamics heavily influence these prices. Track the performance of a group of stocks, giving investors an overall view of the market health. Return expectations from stocks. Can you grow your money like a magic money tree? Spoiler alert, it won't happen overnight. But what if I told you that with patience and the right moves, your money could flourish like never before? Intrigued? You should be. Many investors aim for an annual return between 20% to 30%, but it's essential to understand that the stock market can be volatile. Historically, the average annual return of the stock market has been around 7% after adjusting for inflation. Be cautious about setting unrealistically high expectations and consider a long-term perspective. Diversify your portfolio, stay informed, and be patient. Diversification. Diversification is key to investing in stocks. But what does diversification actually mean? It means spreading your money across different stocks rather than putting all your eggs in one basket. A common rule of thumb is the rule of 20. Divide 100 by the number of stocks you're investing in. For example, if you're investing in 20 different stocks, each stock should make up about 5% of your portfolio. This can help reduce risk and increase your chances of success. Types of diversification, such as asset diversification. This means investing in different types of assets, such as stocks, bonds, and real estate. Industry diversification. This means investing in different industries, such as technology, healthcare, and consumer goods. The risk and reward of stock. Investing in stocks comes with both risks and rewards. On the risk side, stocks can be volatile, which means their prices can go up and down a lot. And if a company performs poorly, you could lose money. However, the rewards of investing in stocks can be high. Over the long term, stocks have historically outperformed other investments, such as bonds or savings accounts. The key is to have a long-term perspective and be willing to ride out the ups and downs of the market. Why it's important to invest in stocks, even though it can be risky. Even though stocks can be risky, they also offer the potential for long-term growth. Over time, the average annual return on stocks has been around 10%. This means that, over the long term, stocks have the potential to provide a higher return than other investments, such as bonds or savings accounts. Of course, there's no guarantee that stocks will continue to perform this way in the future, but they have historically been one of the best ways to build long-term wealth. the importance of investing in knowledge before investing in stocks. Let's talk about the importance of investing in knowledge. When it comes to investing, knowledge is power. The more you know about the market and the companies you're investing in, the better decisions you can make. This could include things like understanding financial statements, analyzing company fundamentals, and keeping up with market news and trends. With a solid knowledge base, you'll be better equipped to weather the ups and downs of the market and make sound investment decisions. That's all about in this video. Thanks for joining me on this journey through investing basics. In the next video, we'll talk about how to choose the right stocks to invest in. See you next time.